What if the next great exchange is not built on Ethereum? What if it does not rely on Solana's speed or Arbitrum's scaling? What if the future of trading itself lives on a chain that built its own foundation, a layer one built purely for performance, precision, and fairness? That chain is Hyperliquid. And this is the story of how a silent project, once overlooked, is rewriting what decentralized finance can be. In 2025, global markets look different. Bitcoin ETFs are live, absorbing institutional capital week after week. Ethereum 2025 upgrades have stabilized gas markets and boosted staking yields. Liquidity is returning. But beneath the headlines, a quieter revolution is unfolding. DeFi is rebuilding its architecture from the ground up, away from centralized custody, away from opaque matching engines, and towards systems that can stand on their own. This is not a hype wave. This is the infrastructure phase where speed, transparency, and composability decide who survives. Until now, decentralized exchanges faced an impossible trade-off. You could have decentralization, or you could have performance, never both. Order book protocols like DYDX and GMX pushed limits, yet still relied on external chains for settlement. Latency, fragmentation, and cross-chain risk remained. Hyperliquid began with a single question: what if the exchange itself were the chain? Not a protocol running on top of Ethereum. Not a smart contract depending on someone else's validator set, but a native layer, one purpose-built for perpetual trading. That decision changed everything. Founded in 2022 by veterans of high-frequency trading and blockchain engineering, Hyperliquid's team studied what made traditional markets like NASDAQ so efficient. They saw that crypto infrastructure lacked deterministic speed. Block production, ordering, and settlement all occurred separately. So they built a consensus layer optimized for synchronized order execution. Every validator in Hyperliquid's network runs an integrated matching engine. Blocks finalize in milliseconds. There is no mempool, no waiting line, no front-running. Instead, trades batch into atomic sets and clear at a unified price. That means fairness is not an afterthought, it is coded at layer 0. But here's where it gets interesting. Hyperliquid is not chasing every use case. It is not trying to host NFTs, gaming, or 1,000 tokens. It exists for one mission: to become the fastest and fairest perpetual DEX in crypto. That narrow focus gives it clarity others lost. Solana aims to be the operating system for everything on-chain. DYDX v4 moved to Cosmos to gain sovereignty. GMX split liquidity between Arbitrum and Avalanche. Hyperliquid chose simplicity: one chain, one purpose, one standard for execution. And that purity of design might be its biggest edge. By early 2025, trading volume on Hyperliquid had quietly surpassed $2 billion in cumulative settlements, a fraction of Binance's daily flow, yet meaningful for a network barely 2 years old. Developers noticed. So did traders tired of downtime and bridge exploits. Funds began deploying market-making bots directly onto Hyperliquid's chain, using its native SDK instead of external APIs. For the first time, decentralized and centralized systems began to converge. And that is where institutions enter. When you talk to fund managers today, they speak less about memes and more about microstructure. They want predictability, compliance, and throughput. They want an exchange that can prove mathematically that no one front-ran their orders. Hyperliquid's deterministic finality provides that audit trail. Each block contains a cryptographic record of trade matching verifiable by any participant. It is not marketing. It is math. And institutions trust math more than promises. Now here is the part most people miss. The Hyperliquid token, HYPE, is not a speculative add-on. It anchors governance, staking, and fee alignment across the network. Validators stake HYPE to secure consensus and to participate in profit sharing from trading fees. Users can delegate HYPE to trusted validators and earn yield from real transaction flow, not inflationary emissions. And fee redistribution means the ecosystem rewards actual usage, a feedback loop that turns activity into sustainability. This one detail changes everything. Because it means Hyperliquid's success is not theoretical, it is measurable, block by block. Technically, the chain pushes boundaries similar to Ethereum 2025 roll-up era, but without external dependencies. Its execution layer integrates zero-knowledge proofs for trade verification, ensuring privacy without sacrificing speed. Block times average 200 milliseconds, and throughput exceeds 50,000 transactions per second under load. Those numbers rival Solana's benchmarks while maintaining validator diversity. More importantly, they are consistent low jitter, stable latency, no lucky blocks. For traders, consistency is everything. That is why some call Hyperliquid the matching engine of Web3. If you value deep research like this, subscribe to Crypto Wayfarer. Every week we decode the real architecture behind the next cycle. Let us zoom out to the macro picture again. Global regulators are drawing new lines. The EU's MiCA framework is live. Hong Kong and Singapore are licensing digital asset exchanges. The US has moved from denial to design, mandating proof of reserves and data transparency for major venues. In that environment, decentralized systems with verifiable settlement gain credibility. Hyperliquid fits that narrative perfectly. It is a blockchain built not for speculation, but for compliance through transparency. A paradox, yet a powerful one. Because the more regulators demand trust, the more markets need code that cannot lie. But every innovation faces risk. Hyperliquid's biggest challenge is liquidity depth. Speed without size means little. Attracting makers from Binance or Bybit requires incentives and stability. The team's solution is gradual migration, bridging synthetic liquidity from wrapped assets, while onboarding real traders through incentive epochs. It is working, but scaling this flywheel takes time. Another challenge is competition. DYDX V4 has brand recognition and a mature derivatives market. GMX V2 remains popular for simplicity. Yet both depend on external layers, and when those layers congest, execution breaks. Hyperliquid's architecture avoids that weakness. It controls its entire stack. Still, decentralization must keep pace. Too much control in early validators could raise questions. Transparency reports show 50 active validators as of Q3 2025, promising, but not final. And this is where things take a turn. Because Hyperliquid's roadmap points far beyond perpetuals. The same deterministic engine that matches trades could match any form of digital exchange, tokenized treasuries, carbon credits, even real-world assets once confined to private ledgers. Imagine a future where an asset manager executes a $10 million bond trade on-chain with zero front-running, audited in real time. That is not science fiction. It is the logical extension of Hyperliquid's design. As real-world asset tokenization grows, a $10 trillion opportunity, according to Boston Consulting Group. Chains that master execution will define finance itself. Hyperliquid's path echoes what SEI did for high-frequency DeFi, but with deeper vertical integration. It merges the trading logic of NASDAQ with the composability of Cosmos and the credibility of Ethereum's ZK proof movement. In short, it brings professional-grade finance to Web3. That is why smart money is watching. Not to chase a narrative, but to capture an edge. When latency becomes advantage, architecture becomes alpha. And Hyperliquid was engineered for alpha. The broader takeaway is simple, but profound. Crypto's next era will not be defined by hype tokens or fleeting narratives. It will be defined by invisible infrastructure systems that just work, silently handling billions in value without error. Hyperliquid belongs to that lineage. It may never trend on social media like meme coins, but it could quietly become the rail that those coins settle on. Because when volatility returns, and it always does, traders will seek the venue that never wavers. The chain that clears trades when others pause. The protocol that treats fairness as physics. That is Hyperliquid's promise. So where does this leave us? If you are a builder, Hyperliquid offers precision and composability, an execution layer built for complexity. If you are a trader, it offers certainty, no mempool, no front run, no excuses. And if you are an investor, it offers something rarer, still an asymmetric bet on infrastructure during a time when trust is currency. The next DeFi boom will not start with a meme. It will start with architecture. And Hyperliquid might just be the blueprint. Stay sharp, stay strategic, and keep wayfaring.